Hi everyone, welcome to the third video of Chapter 9, Ratio and Rate, where we'll be learning about simple interest, hire purchase, and income tax. So of course, in this video, we're going to learn how to calculate these three aspects, which are just applications of rate. Okay, now simple interest, okay? This is quite complex, so we first got to understand it in the context of when you're depositing money in the bank. So let's say you're Tom, okay? Tom, you have $1,000 saved up from your Chinese New Year or Hari Raya visiting, and then you want to put it in the bank for safekeeping. Alright, so the initial amount of money put in the bank is what we call the deposit. Okay, and sorry, the what we call the principal, and in this case it's $1,000. So the bank will keep this $1,000 safe for you, and if you don't touch it for a full year, all right, you'll get interest, which is the amount of money that the banks pay you for keeping money in their bank. So normally we consider this interest at a rate of every year, so we call it per annum. Okay, so let's say if the bank give you an interest rate of 3%. What does it mean? It means that for the principal of $1,000, all right, they will pay you back 3% of it to you. All right, maybe your total balance will actually increase by 3%. So 3% of $1,000 would then be $30, and that's how you can get sort of passive income by putting money in the bank and getting interest from it at the rate of 3% per annum. However, in the context of borrowing, okay, it is not so simple. So let's say, Tom, you want to borrow a total principal amount of $1,000, let's say to buy a bicycle. After you borrow it, the bank will then charge you interest rate, which is the fee incurred from borrowing. Banks are very smart because they want to earn money, so they will charge you a higher interest rate per annum for borrowing as compared to when you deposit money with them. Okay, so in this case, they charge you an interest rate of 5% per annum, which means per year. So after one full year, okay, out of this principal of $1,000, the bank will actually charge you 5% as interest, and then the debt, which is the amount of money you owe to the bank, will actually increase by $50, which is that 5% based on your principal amount of $1,000. Okay? Okay, so to summarize, the simple interest is the amount of money you earn when you deposit money in the bank. However, simple interest can also be used as the fee incurred when you're borrowing money from the bank. So it depends on the context of the question. Okay? So let's look at some example here. A student invests $5,000 in a savings account that pays a simple interest rate of 4% per annum. So take note, per annum just means per year. Find the time taken for the interest rate to grow to $5,800. So let's think about it. In 1 year, all right, the interest earned would then be 4% of $5,000. Okay, so you type in the calculator, right? 4% of $5,000, you will get $200. In the question, it says that he has a total amount of $5,800. So then the total interest earned would then be 5,800 minus away your initial amount of $5,000. That will give us $800. We're getting somewhere. So if you know every year he gets an interest of $200 and the total interest is $800, then the time taken would then simply just be 800 divided by 200, which will give us 4 years. Okay, I hope this is clear with everyone. So every year the student earns $200. And the time taken to earn $800 would then just be 4 years. Okay, let's look at a different question, a bit more complicated, all right, in the case of borrowing. So a student takes a loan of 80,000 from the bank at a simple interest rate of 6% per annum. If the student plans to return the loan at the end of 4 years, find the amount of interest he has to pay. So let's do part A first. Let's calculate the interest per year. Right? So we have 6% per annum. So multiply by the initial principal of 80,000. Alright. You should get 4,800. Wow, that's a lot of money. So the total interest would then just be the 4 years, alright, multiplied by the interest charged per year, which is $19,200. Well, that's a lot of money. Okay, so the total for part B, let me just write here, total amount owed would then be your initial principal amount of 80,000. Alright, and you add the total interest of 19,200. Alright, and this gives you a grand total of $92,200. So what does this question show you? This question shows you that when you borrow money from the bank, it's not so simple as, when you borrow $2 from a friend and you return your friend $2 next day. Banks are not so friendly. So notice that every year as you extend the duration of your repayment, they will charge you a fixed amount of $4,800. And at the end of the 4 years, you're actually paying an extra amount of $19,200, which is a lot of money. Okay, so this simple question has just showed you that when you're taking a loan, be careful of the interest rate. Alright, it may end up adding almost a quarter more to your total loan. Okay, now the next idea we're going to explore is hire purchase. So hire purchase is meant for the scenario where you're purchasing a very expensive item like a cost of a car. So in Singapore, actually the cost is way more, but I just lower it down to a very nice number of $100,000. What if I don't have $100,000 to pay right away? Is there another way that I can pay? So what you can do is to break up this $100,000 into this total cost of the car. Alright, so the initial 20% of the car, let's say this is $20,000. Alright, is what we call the down payment. So the down payment is the initial upfront sum paid to the car dealer at the time of the purchase. It can be a car dealer, it can be the bank. So you pay the $20,000 to the person that is lending you the money. So in the case, will be the bank. Alright, so this is the amount of money you have to fork up at the very front, and you must have it at the point of purchasing the car. Now, the remaining $8,000, alright, over here, right? The $8,000. It's $80,000. What happens to it? So the remaining $18,000 will actually be spread across a period of time, maybe 24 months, maybe 36 months. So we just spread out across, so each month you pay a small sum. In this case, it is much easier to pay as compared to the full lump sum of $100,000 at the very start. However, there's a catch. The bank is very smart. They will charge you this additional amount called the interest, which you have to pay back in addition of the $100,000 over here. So what happens when you pay for hire purchase is that you end up paying an amount that is much greater than the original $100,000. That is the trap that people use in hire purchase to ensure that you pay more than the actual value of the car. Alright, let's look at an example. So a bicycle shop sells a mountain bike for $1,200. It turns decided to buy it using a higher purchase plan with a down payment of 25% and paid in equal installments over 3 years at a simple interest rate of 8% per annum. So first thing, they ask you to find the monthly installment. Okay, so when you pay a down payment of 25%, okay, so for part A, let's find the down payment first. So down payment would then be 25% of your initial 1,200, which gives you $300. Okay, next we calculate the remaining amount because our interest is always based on the remaining amount that is unpaid. So we get 300, we multiply by 1,200 minus off away the 300, we'll get back $900. Okay, and then the interest would be 3 years of 8% of the remaining amount. All right, which is just 900, and that will give us 3 times 8% times 900, that will give us $216. Okay, so this is the interest and this is the remaining amount. So then the total, quite a bit of steps, total installments would be the remaining amount, which is $900, all right, over here, and we will add up the interest, which is 216. Okay, which gives us a grand total of $1,116. This is a total installment. And since we are spreading across 3 years, how many months is 3 years? 3 years would then be 36 months. All right, so the monthly installments, which is the amount that we are spreading out our costs, would be 1,016 divided by 36, which gives us $31 per month. So all Ethan have to do is pay $31 per month. However, in part B, they ask you to calculate the total amount Ethan paid for the bike. Then we have to add up the initial down payment, which is $300, and we add up the total installment, which is 1,116, which gives us a grand total of $1,416. Notice now, look at the amount that Ethan has to pay extra compared to the original amount. He has to pay a total extra of $216, which is our interest. That's quite sly of the bicycle shop, right? But that is how the financial institutions work. They let you pay a small amount upfront, which is your down payment, all right, which is $300, and then the remaining amount with the interest, all right, with the interest here is paid over monthly installment of $31. It's manageable, but then slowly the interest actually stacks up, and then that's how it adds to your total cost. Okay, next thing is currency exchange. Currency exchange is very important when we're going overseas. So let's look at this example. The currency rates between yen, Singapore dollars, and Thai baht is as follows. 1,000 Japanese yen is equals to $9.85, and 1 Thai baht is about 0.0385 Sing dollars. So let's look at part 1 first. Alright, since we know 1 Thai baht equals to SGD 0.0385, to get Thai baht of 18,600, we simply just take SGD 0. Oh, sorry, why did my D become an 8? Okay, 0.0385 multiplied by 18,600, which gives us SGD 7 116.10. Alright, take note to leave in 2 decimal place. And in part 2, we know that 1000 Japanese, oh my bad, Japanese yen 1000 equals to SGD 9.85. So to get Japanese yen of 72,500, what we can do is we actually can, instead of finding 1 yen, we can actually multiply, if you are able to look at it fast, multiply by 72.5. Okay, so 9.85, 72.5 give us SGD of 714.125. But because we're talking about Singapore dollars, we round it off to the nearest cent given by the question, which is 714.13. All right, the nearest cent. Okay, I hope this is clear for everyone. Okay, the last thing of this video will be about income tax. So income tax is the fee charged by the Singapore government based on how much you earn in that year. Alright, and it's charged based on a tiered system, or what we call it income bracket. Okay, so income bracket, we have to look at different tiers. So this is a sample income tax table from the textbook in page 59. So this chargeable income is the amount of money you earn in that year. Okay, so let's look at this table. In the first $20,000 you earn, they charge you a tax rate of 0% on this 20,000. And in the next 10,000 that you earn, they charge you a tax rate of 2%. And subsequently, the next $10,000, they charge you 3.5%. So notice that in the tax rate generally across the world, this is what we call a progressive tax, where the more money you earn, the tax rate actually increase. But the tax rate is only affecting that bracket of money. So example, this 2% will only affect the next 10,000. The next 3.5% will only affect the 10,000 afterwards. Okay, so let's look at some examples to get a better idea. So let's say if you earn $18,000 annually, which bracket will you fall under? 18,000 will fall directly inside the first bracket, right? Because the first $20,000 that you earn, and they charge you a tax rate of 0%. So the tax is equivalent to 0% multiplied by 18,000, and that's give us $0. So if you earn a very low amount, the government won't charge you any taxes because it will be not fair to people who are earning lower wages. Let's look at the next case of $26,000 annually. So for the first 20,000, we know that there is $0 charged to it. Alright, so the first bracket, you are quite safe. However, notice that after the first $20,000, so $26,000, you minus away the first bracket, 20,000, you are still left with a remaining $6,000 in the next bracket. This is called the next bracket. And the next bracket lies in the blue portion over here, the next $10,000, and it charged 2%. However, this 2% is not based on the whole $26,000, but is charged only, only on the $6,000 that exceeded into the next income bracket. Alright, so then the total tax is equivalent to 2% multiplied by 6,000, which is $120. Is it okay? So total tax is just $120 plus this $0, which is sort of free. Okay, next one is a bit more complicated. And 69 per 69,000 annually. Okay, so we all know that the first $20,000 free of charge. All right, so this one zero taxes. Okay, so the first 20,000 this is free. Okay, the next 10,000 so this 10,000 we also hit. All right, we have covered the bracket fully. Then we look at the third one, next 10,000 also hit. All right, because our $69,000 include this first 20,000, next 10,000, next 10,000. So far total is still 40,000. And for the last bracket over here, last 40,000, that is where we supplement with the remaining $29,000 from our total income. Okay, our total income over here. So then let's calculate each tax of the individual income bracket. So the first one, our tax, all right, would be 0% of 20,000, which is $0. Next one, we have 2% of $10,000, which is let me calculate, $200. All right, then we have 3.5% of 10,000, which gives us $350. And the last one, we have 7% of $29,000. Okay, which gives us $2,030. So our total tax for our third case would then be 200 plus 350 plus 2,030, which gives us $2,580. Okay, so this is how we calculate the total income tax for our third case who earns 69,000 annually. Okay, now let's look at a more realistic example of how the income tax is given in our year of assessment 2024 onwards. Okay, let's say you earn $23,000 this year. Okay, let's look at this table. So $23,000 lies in which one? So most of you have spotted this is the income bracket that you fall into. For the first $20,000, income tax rate is 0%. So if you charge 0% of 20,000, you get 0 taxable dollars. However, you still exceed by 3,000, right? So this is 20,000 and you add another $3,000. So this $3,000 is in the next bracket. Okay, so in the next bracket, we have an income tax rate of 2%. So then what we simply put is just tax equals to 2% of this $3,000, which is just $60. Is that okay? Okay, good. Let's look at next question. What happens if your chargeable income is 47,000? Okay, so 47,000, let's look at our table. Where will it fall under? 47,000 will fall under over here. All right, so 47,000. The first 40,000 will be under the first row, which is $550. All right, that is what the government has helped you calculate. So then you have to break it up into 40,000 on the top and the next 7,000 at the bottom. All right, so this is how we break up our income bracket. So for the first 40,000, we have a fixed rate of $550, but the next 7,000, it will charge you at 7%. All right, So then our total tax would be $550 for the first 40,000. This is the first 40,000, and then we add up 7% of the 7,000 in the next one. All right, so this will give us 550 plus 7, 490. Total would be 1,040. Is that okay? And for the last example, let's say you have a taxable income of $120,000. This is a lot of money. All right. Actually, this one is quite simple, because for $120,000, we can simply just look at the last one, and just nice you calculate for the first $120,000. So your taxable income would just be $7,950. So the total tax is just $7,950. Is that okay? So this is how you read the income tax bracket table. So first, you look at the total amount that you earn in the year. Look at the chargeable income. You see where does it fall under. All right, if it's 120,000, it falls under first 120,000. If you earn 47,000, you look at this bracket over here, where you earn the first 40,000 and then the subsequent 7,000 will be charged at 7%. Okay, and likewise, if you earn 23,000, all right, your first $20,000 would be free, but the next 3,000 will be charged at a rate of 2%. Okay, and that's how you get $60 respectively. Okay, if not, then we have come to the end of our video. All right, and hope you can have a better idea of hire purchase, exchange rate, as well as income tax. And I'll see you in the next video.